I still remember the exact moment I realized I'd been leaving money on the table for years. It was a Tuesday afternoon, sitting at my kitchen table with my laptop and a half-empty cup of coffee that had gone cold. I was doing what I thought was a routine portfolio check-in. You know, the kind where you glance at your returns, nod your head, and think, yep, I'm doing okay. Except this time I wasn't okay. I had just stumbled across an ETF I'd never heard of, and when I compared its performance to my beloved VOO, the S&P 500 fund everyone swears by, my stomach dropped. This fund wasn't just beating VOO by a little. It was crushing it, and not just in the best years, but consistently, year after year, with better downside protection when things got ugly. I sat there staring at the screen, feeling this weird mix of excitement and anger. Excitement because, holy crap, this thing existed. And anger because where was this 5 years ago? Where was it when I was pouring thousands into VOO, thinking I was being smart and disciplined? Here's the thing nobody tells you about investing. Playing it safe can actually be the riskiest move you make. Not because you'll lose money, but because you'll spend decades wondering what could have been if you'd just known a little more. And I'm not talking about some obscure penny stock or a risky gamble. I'm talking about a legitimate low-cost ETF that's been quietly outperforming the market, while most of us were told to just buy VOO and chill. So in this video, I'm going to show you exactly what this ETF is, how it works, where the returns actually come from, and most importantly, how you can use it without blowing up your risk tolerance. Because if you're watching this, you're probably like me. You're not trying to get rich overnight. You're trying to build real wealth that lasts. And what if I told you that just a small tweak to your portfolio, maybe 10 or 20%, could potentially add tens of thousands of dollars to your retirement? Not someday, not theoretically, actually based on real data. That's what we're diving into today. Let's break it down. So, let me take you back to that Tuesday. I had been reading an article about momentum investing, and honestly, I was skeptical. It sounded like one of those Wall Street buzzwords designed to sell complicated products to people who don't need them. But something in the article stuck with me. It mentioned that certain ETFs were not only beating the S&P 500 in bull markets, but they were also losing less in downturns. And that combination, that's incredibly rare. So I started digging. I pulled up my brokerage account, opened a new tab and typed in Momentum ETFs outperforming S&P 500. That's when I found it, SPMO. The Invesco S&P 500 Momentum ETF. At first, I thought it was just another niche fund, but then I looked at the 5-year chart compared to VOO, and I literally said out loud, wait, what? If I had put just $10,000 into SPMO 5 years ago and didn't touch it, I'd be sitting on around $23,000 to $24,000 today. That same $10,000 in VOO, about $18,400. That's a difference of nearly $5,000 on a single lump sum. Now imagine if I'd been dollar cost averaging $500 a month into it. The gap would be even bigger. That moment hit me hard because I realized I wasn't just underperforming. I was missing a strategy that actually adapts to what the market is doing instead of just riding it passively. All right, so what exactly is SPMO? Let's get into it. SPMO stands for the Invesco S and P500 Momentum ETF. And it does something beautifully simple. Instead of holding all 500 stocks in the S&P 500 like VOO does, SPMO narrows it down to about 100 stocks. But not just any 100. These are the companies with the strongest upward momentum based on their recent price performance and stability. Think of it like this. The S&P 500 is the entire NBA. SPMO is the all-star team. It's pulling the best performers from an already elite group. Here's how the selection process works. Every 6 months, SPMO recalculates a momentum score for each stock in the S&P 500. That score is based on how much the stock has gained over the past 12 months, excluding the most recent month to avoid short-term noise, and how consistent that rise has been. The fund then selects the top 100 or so and rebuilds the portfolio. So you're always holding what's working right now, not what worked 2 years ago. And here's the kicker. You don't have to do anything. The rebalancing happens automatically. No guessing, no market timing, no emotional decisions. It just rotates winners in and losers out every 6 months like clockwork. The expense ratio is 0.13%, which is slightly higher than VOO's 0.03%. But considering what you're getting in return, it's a no-brainer. This isn't about chasing trends. It's about systematically owning strength and letting go of weakness. And as you're about to see, that simple shift has led to some pretty incredible results. Now let me show you the numbers that made me pause. When I pulled up the performance data for SPMO, I wasn't expecting much. Maybe 1% or 2% better than VOO if I was lucky. But when I saw the actual returns, I had to double check the chart because it felt too good to be true. Since its inception in 2015, SPMO has averaged around 18% annual returns. VOO, over the same period, about 14%. Now, that might not sound like a huge difference on paper, but let's do the math, because this is where it gets real. Let's say you invested $10,000 into SPMO 10 years ago and just left it alone. At an average annual return of 18%, that $10,000 would grow to approximately $52,338. Now take that same $10,000, and put it in VOO with a 14% average return. You'd have about $37,072. That's a difference of over $15,000 on a single $10,000 investment. But it gets even crazier over 20 years. That same $10,000 in SPMO at 18% becomes roughly $273,930. In VOO at 14%. Around $137,435. You're talking about a difference of over $136,000 from the exact same initial investment. Now let's use the rule of 72 to put this in perspective. The rule of 72 is a simple formula to estimate how long it takes for your money to double. You divide 72 by your annual return rate. At 18%, your money doubles every 4 years. At 14%, it takes about 5.1 years. Over a 30-year investing timeline, that one extra year per doubling cycle adds up to life-changing money. But here's what really blew my mind. Let's talk about what happens when the market tanks. Most people assume momentum investing is risky. They hear momentum and think it's some volatile roller coaster strategy that'll wreck you in a downturn. But SPMO actually tells a different story. Take 2022, one of the worst years for the stock market in recent history. VOO dropped about 18%. Brutal. But SPMO, it only fell around 10 to 12%. Now don't get me wrong, a 10% loss still stings. But when you're comparing losses, that difference matters a lot. Because the less you lose in a downturn, the less you need to gain to get back to break even. If you lose 20%, you need a 25% gain just to recover. If you lose 10%, you only need an 11% gain. And that compounding effect of smaller losses can be the difference between retiring on time or working an extra few years. Let me give you another example. In 2018, the S&P 500 dropped about 4.5%. SPMO only dropped around 0.9%. And during the COVID crash in early 2020, while everything was falling, SPMO rebounded faster because it was already rotating into the stocks that were recovering the quickest. Here's why this happens. Because SPMO rebalances every 6 months. It's constantly shedding the losers before they drag the whole portfolio down. It doesn't hold on to a declining stock out of loyalty or hope. If momentum fades, the stock gets cut. That systematic approach to risk management is what gives SPMO its edge. It's not about picking the next big thing. It's about consistently holding what's already working and letting go of what's not. Stick around, because we need to talk about the risks next. And yes, they're real. All right, before you open up your brokerage app and dump everything into SPMO, let's pump the brakes and talk about the downsides. Because momentum investing isn't magic and SPMO isn't perfect. The first thing you need to know is the concentration risk. Because SPMO only holds about 100 stocks instead of 500. And because those stocks are weighted by momentum, the fund can get heavily concentrated in just a few names. Right now, for example, companies like Nvidia and Meta make up nearly 20% of the entire fund. When those stocks are on fire, SPMO flies. But if they have a rough quarter, SPMO feels it hard. That's the trade-off. You get higher upside potential, but you also get sharper swings in the short term. Some weeks VOO might drop 1% and SPMO drops 2% or more. That's just the nature of holding fewer, higher momentum stocks. The second risk is performance in choppy or sideways markets. Momentum strategies thrive when there's a clear trend up or down, but when the market is just bouncing around with no direction, SPMO can underperform. It's not designed for every single market condition. And the third thing, this is not a set it and forget it forever fund, or at least it shouldn't be your entire portfolio. If you go 100% into SPMO and we hit a prolonged period of volatility, you're going to have a rough time emotionally. But here's the thing, that same concentration and volatility is exactly why SPMO has outperformed. It doesn't spread itself thin across 500 companies. It leans into strength. And yes, it's more volatile, but does it fall apart in every downturn? In fact, as we've seen, it often holds up better than you'd expect. The key is treating SPMO as a strategic piece of your portfolio, not the whole thing. Which brings me to the next part. Where does this actually fit? So let's talk portfolio strategy. You've probably heard of the classic 3-fund portfolio. It's simple. You've got US stocks like VOO, international stocks, and bonds. It's diversified, low cost, and it works for a lot of people. But here's the problem. SPMO doesn't fit neatly into any of those categories. It's not foundational like VOO. It's not pure growth like QQQ. It's not value like SCHD. It's something in between, and that's exactly why it's so powerful. I think of SPMO as a performance enhancer for your core portfolio. You don't replace VOO with it. You add it. Here are a few ways you could structure this. Option 1, the conservative approach. 70% VOO for your foundation, 20% SPMO for growth and momentum, and 10% in bonds or a dividend fund like SCHD for stability. This keeps you mostly anchored to the broad market while giving you upside exposure. Option 2, the moderate approach, 60% VOO, 25% SPMO, and 15% in SCHD or bonds. This bumps up your momentum exposure a bit while still maintaining balance. Option 3, the aggressive approach for younger investors with longer time horizons. 50% VOO, 30% SPMO, and 20% in a growth fund like QQUM. This is higher risk, but if you're in your 20s or 30s and you've got 30 years until retirement, this kind of allocation can seriously accelerate your wealth building. The point is, you don't need to go all in on SPMO to benefit from it. Even a 10 to 20% allocation can make a meaningful difference over time. And that's the beauty of understanding your tools. You're not just buying what's popular. You're building a portfolio with intention. So let me leave you with a question I had to ask myself. Are you hoping the market carries you to freedom, or are you building with real intention? Tell me your answer in the comments.